part 2 of this chapter really gets to the end result, which is how do we calculate the actual weighted average cost of capital for the company. In other words, on average, what does it cost the company to finance its products? So the weighted average cost of capital is a formula. We have three basic costs. You have the cost of debt, you have the cost of preferred stock, and you have the cost of equity. Now remember, with respect to equity, R sub R is the cost of retained earnings, and R sub N is the cost of new common stock. And we'll probably say this again a little bit in a couple more slides, but let's think about the relative costs of the sources. Debt is the cheapest source for two reasons. Number one, it's the least risky. Number two, this is the after-tax cost, so the government's going to subsidize some of the cost. Next in line is preferred stock, and then equity is the most risky, so it's going to be the most expensive, but the cost of retained earnings is less than the cost of new common stock. Again, why is it less? Well, it's less because new common stock requires flotation expenses. You actually have to issue and pay commissions and legal fees, etc. So there are additional costs in using new common stock rather than using retained earnings. So they say here it's easiest to, first of all, you want to use the weights, the proportions and decimal forms, and leave the cost in percentages. The weights can't be non-negative. They have to be positive. They have to add up to 1, right? And of course, we're going to have to decide, are we going to use retained earnings, or are we going to use new common stock as our financing tool? What will ultimately happen, though, is we need two costs. What does it cost to use retained earnings? And what does it cost when we're going to use or issue new common stock? So here's a company. They have $32.65 in bonds at $980 a piece. They have 14,545 shares of preferred at $55. They have 80,000 shares of common stock at $50. The book value can be calculated, or the weights can be calculated as, again, we have 32.65 times 1,000. So there's 69% debt, 22% equity. Preferred stock is about 9%. Now, if we convert that to market value, we get slightly different numbers. Debt's 40%, preferred stock is 10%, and common equity is 50%. So which one should you use? We'll mention this a little bit later in the slide, but we would prefer to use market values. The reason we really want to use market values is we're talking about the cost of getting new stuff. So we're going to have to pay the new prices, not the historical prices for the assets that we buy. So here we have a calculation. We can go to the spreadsheet, and here we can input the market values. Here are the values of the assets. Roughly it's $8 million. Here are the weights, 40, 10, and 50. And from that previous example, here are the costs for each one of these financing tools. So again, we want to utilize or talk about the ultimate calculation. Remember, it's the weights times the cost. So in this case, if we use this thing that's called the first tier, this is the cost using retained earnings. So it costs the company on average 9.83% if they use just retained earnings, or retained earnings with preferred stock and with debt. But if they don't have enough retained earnings and they have to issue common stock, it's going to cost 10.32%. Again, we mentioned this. Do you want to use book values or market values? Market values are preferred. Do we use historical weights or target weights? Again, target weights are preferred. And maybe the company wants to change its financing mix. Historically, they've been doing that 40, 10, and 50. Well, maybe they want to change and they want to do 30, 20, and 50. So from a theoretical point of view, we want to use the target market values when we're talking about the weighted average cost of capital. The marginal cost of capital, though, is the concept that there are different cost structures. Again, we've already alluded to this. We didn't call it the weighted marginal cost of capital. The cost of retained earnings is less than the cost of common stock. So if you start gathering money, you're going to gather money in the cheapest form possible. So you're going to use retained earnings as your equity source. But when you run out of retained earnings and you still want more money, you have to increase the cost because now you're going to have to issue common stock. So how does that impact? What does that do to the structure? Well, first of all, we have to find out where does that happen? When do we run out of financing and have a cost go up? So the concept here is something called the break point. You take the A sub F here. AF is the amount of funds available for a given cost. When we're talking about retained earnings, that would be the amount of retained earnings you expect next year. Divide that by the weight of that capital structure, and it will tell you when you're going to run out of retained earnings and at what amount of financing you're going to have to switch to the higher expense item, which then, of course, from there on out, the weighted average cost of capital changes. So here we have an example. We have $2 million in retained earnings. We also believe we can raise $1 million of the cheaper debt, but after that, the after-tax cost is going to go to 7%. How can this impact us as far as our financing debt? Well, here we go. Where it says break point, to put in that break point data, $1 million is where we run out of the cheap debt. $2 million is where we run out of retained earnings. And we know that the after-tax cost is 7%. So now we have three costs. When you first start gathering money, 9.83% is what it costs at cheap debt, preferred stock, and using retained earnings. Then later on down the line, you're going to run out of cheap debt. You see that the break point is at $2.5 million. So from $2.5 million upwards, it's going to cost us $10.36. More expensive debt, preferred stock, and still using retained earnings. But the final break point is going to be 10.86%. More expensive debt, issuing preferred stock, and now from $3.9 million on in financing, we're going to have to issue new common stock. So that's the basis of calculating the weighted average cost of capital.